I went from being a broke kid to a 2-time X Games gold medalist, managing 450 million of assets under management. There were 5 methods I look back at that significantly moved the needle, that really transitioned me to creating more wealth and finding more success than I'd ever found before. And these can drastically change your life. Here's the 5 methods. Number 1 is knowing when to course correct. When I look back at my snowboarding career and I came into challenges, and let me just be really clear, there were extreme challenges, extreme setbacks, major injuries. And the piece that needs to be heard and really understood is that I wasn't quitting, I was course correcting. And as you build a company, right, as you go for a major goal, the biggest piece is to have the end goal or the end outcome clearly in mind. And then how do you course correct to get around these challenges that are guaranteed gonna come up? There is no such thing from my perspective and my experience as going from a newbie in snowboarding to a professional athlete, a newbie in business to a successful entrepreneur. There will be challenges, there will be problems, there will be things that need to be overcome. And the course correction piece, real time, like you're flying the plane, right? When you're building a company, the plane's in the air. You've got to course correct. You got to build the plane while you're flying it. That's how building a company is. That's how becoming a professional athlete was, or at least that's how it occurs to me. So the ability to course correct, to adjust, to learn from your mistakes, to put in new criteria in real estate, to be aware of different areas where you could have major setback and injury as a snowboarder. One thing, when we were setting up spots for X Games in real snow, one of the things we were doing all the time is getting ahead of the place or the specific, spot that could have caused major injuries. So like anytime we'd set up a major spot in snowboarding, there was a possibility of major injury. And there were specific points of the trick that could have created a bigger injury or is just more dangerous. So how do we get around that? How do we protect that? How do we build in safety so that if we do have worst case scenario happen, we don't completely get wiped out? I don't have a major injury. Same with business. You're buying real estate. How do you protect yourself to take out worst case scenario? Some of those things we do is low leverage fixed debt. Now when the economy shifts, you've got safety, you've got a cushion, you've got a longer track record of time to be able to drive NOI, which is what we're here to do. What I learned during my snowboarding career, creating a high self-employed income or W-2 earners that are making a lot of money, if I don't spend the money properly or allocate the capital properly, I get trapped. So I'm over here in my snowboarding career and I get lucky to sign some of these big contracts. I think there's some luck involved here, but you sign these big contracts and all of a sudden you've got options. Hey, am I gonna go buy a house? Am I gonna go buy a car? Am I going to start traveling with my buddies and just make it a party fest? And if I go down that path for too long, which a lot of W-2 high income earners do, what happens is you get trapped. You actually get stuck into a lifestyle where you become a slave to your job. Athletes don't really realize it, but if you get a big contract, you sign a contract for 30, 40, 50, 60,000 a month, and all of a sudden you go lock yourself into a 30-year mortgage where your mortgage is 30, 40 a month, you're basically locked into that mortgage payment. And when your contract ends, you're now trapped. It's a scary place to be. And as a W-2 income earner, if you're a high W-2 income earner, if you've locked yourself into a lot of bad debt, and bad debt is debt that I'm paying for. Bad debt is money that I have to service. Good debt would be debt where in apartments or real estates where our residents pay for it. So it's a very big difference of understanding if I'm getting locked into bad debt or if I'm getting locked into good debt. And bad debt is trapped. It cages you. It makes you feel confined, right? And so when that career ends, or if it needs to end, for my case where I got fired, when that came to be, that's where the most pain hits for most athletes and a lot of high W-2 income earners if they want to change or if they get let go. So the biggest thing I got to say is as you are wanting to transition because you can see a better path, a more freedom path, which is totally was my goal in the beginning during my snowboarding career, is how do I transition from being this snowboarder, having passion, having freedom, into an entrepreneur to have passion, have freedom. If you're a high W-2 income earner and you might be seeing and saying the same thing, you've got to live below your means. It's really important to delay gratification. It's important to allocate the funds you're making in a place where you're accumulating good debt. And be aware of that. If you're not clear with good debt or bad debt is, follow us. You can learn so much more about how we're doing these deals and why we're doing these deals and allocating good debt into our portfolio that creates freedom. Yeah, there was a moment in time where I met with my CPA and he educated me. If you don't have a great CPA, you guys, I strongly encourage you to get that person on your team. And that CPA shared with me that my high income, my W-2 income, actually was a trap, right? It ended up creating a position where I felt like I had to go and snowboard. I had to go and compete. I had to be successful. And the brands, they were about as harsh as you can imagine, where, yep, you're on the team, to 3, 6, 8 months later, you are done. When I got fired, when I got let go, it wasn't this heads up, this is coming, we're gonna reduce you nicely over a 2-3 year period. It was a phone call where when that person called me, it sounded like someone died on the other end. I literally remember his tone. I remember where I was sitting. I remember the point in time of him calling and saying, "Brisse, dude." And I'm like, "What's up? You all good? Everything okay?" He's like, "Man, we gotta let you go." And I still remember the moment in time. Luckily, I'd been preparing, getting into good debt, right? Allocating capital that could start paying me. So it wasn't this big loss like it is for a lot of athletes. But that transition period, my CPA luckily woke me up 5 years before that point happened and said, "Hey, Dan, you've got to start creating multiple streams of income. You've got to start creating passive income." And so from that point on, what a gift it was to have an educated CPA in my team to help me get on the right path, to help me get down the right direction, so that when the phone call came, I wasn't sitting there with my pants down. Yeah, when we're allocating capital and we're looking for our next asset, there's a period of time called due diligence. Your due diligence period is the most important time you will have to get really clear on if this deal is actually a good deal. You're gonna know by the time due diligence is done, which is just a 2 or 3 day period. You're gonna get inside 100% of the units. You're gonna have your vendors crawling all over the exterior. You're gonna check out the parking lot, landscaping, electric, plumbing, windows, everything on the property. And as you get that information back from your vendors, who ideally have done many due diligence inspections for you, you're gonna get a really clear picture of what this asset needs in order to maintain it. And at the end of the day, if you're not thorough during your due diligence period, this is the part where deals fail before you even close. If you can get your capital right, because you know this asset intimately, inside and out, plus you know the financials of how to underwrite it accurately, when you put all that together, you can start to see a vision of the future of what you can actually do with that deal, right? And so until you have that information to that level, you're really doing your best to give the most accurate assessment, the most accurate value to that seller. And then you really get the point of go or no go once you get all that information. But until you have that information, you're taking a little bit of a risk in real estate. And that's just the way it is. You go through, before you put a deal under contract, before you have a purchase sale agreement, which is the contract that says you're gonna buy the deal. Before you do that, you've got to get as great as you can at estimating based off of what you can see in your property tour. And the more you do it, the more accurate you'll get. But it is absolutely incredibly important to get all that data, put it all together after due diligence, then make your assessment with the CapEx that's needed. Because once you sign on that dotted line, once you close, all the good, the bad, and the ugly of that asset is now under your ownership. So you have got to have the capital allocated properly. Put that in your spreadsheet. If it changes your returns too significantly, better to walk and get out versus buy a deal that you've come in undercapitalized. Number 2 is finding your inner why and delaying gratification. Yeah, I think delaying gratification is one of the most important traits any human being can learn and adopt. During my snowboarding career, I was at a point where I was making between 500 and 600 grand a year pretty comfortably. And I got the gift of being around many other pro athletes. And some of these guys were 5 or 10 years in front of me, and I got to see their lifestyles. Right? I got to know them very well. We would be snowboarding together, we'd be hanging out on the weekends, and they became my really good friends. And when I saw their careers winding down 5 or 10 years in front of mine, and I saw what that looked like, it was very clear to me that I had to do something different with my capital. So no matter how much money I made, I ended up living on about 60,000 a year. And so during my career, making 5 to 550, 600 grand, and I'm living on 60K, it allowed me to start to pump away a lot of capital into different real estate investments, again, to create passive income, right? To hedge inflation, to find depreciation, because those are the 3 vehicles. Those are the 3 ways I found to most quickly accelerate my wealth. And so I look back as a gift to be able to have met these guys and to have been face to face face with them, because when I was with them real time, right face to face, it was as real as it could get, right? When I saw some of their homes being taken away, it was devastating for me. You know, when I saw them traveling around the world with their friends and coming back with tattoos on their face saying money ruined them, it was absolutely a punch to my gut. So to delay gratification for a 3, 5, 7-year period for a high income earner, a W-2 income earner, and then be free or much financially more stable the rest of your life is invaluable. You know, when I think about the why, when they always say it, when the why is big, the how is easy. And I could not agree with that more. Heck, I was here talking with my mom yesterday. She's 80. And she was telling me that her friend called her and said, hey, let's lose 5 pounds together over the next 30 days. And I was really proud about my mom because she was like, no, I don't want to do that. The thing that hits over and over again for me, and it seems to be true, is that until you have a big why, it is really, really difficult to do what needs to be done. And so when I look at my snowboarding career, when I look at what we're doing here at Granite Towers Equity Group since 2017, you know, Mike and I building our company, the why for us has always been freedom. It's how do I create enough income so that money is not an issue? It wasn't and isn't to go buy big homes. It's not to buy a Ferrari. It's not to look big on social media, which it seems like you have a lot of folks out there that are fake gurus or potentially, you know, just showboating stuff. The real reality is why are you out going after this? What is the reason, your inner reason of why you want to create wealth? You know, and no judgment passed. You can have any reason you want. From my perspective, what I've found is that as long as my why is something that aligns for me personally, the how becomes much easier. And so for my mom saying, no, I don't want to lose weight over the next 5 days. Now she says to me, she's like, Daniel, you know, I kind of wish I would have, because now my size large doesn't fit, or now my size medium doesn't fit. And as she keeps getting feedback, she's getting new painful lessons because she didn't want to take, you know, the action. Those painful lessons create a bigger why. So a lot of times, unfortunately, people have to go through more pain. They have to experience more pain before they're really ready to make the change. But once you decide and you have a why, the how is easy and it's almost guaranteed to come to you. By the way, if you're listening to this and you're getting crushed by taxes or inflation, inflation is a silent wealth killer, the silent wealth stealer. You've got to get on the side of inflation. If you want to learn more about what we do, book a free call with us and we can take a look to see how you're structured and see if we can help you become more financially efficient. Number 3, seeking out discomfort. You might have gurus say that passive income is quick and double, triple your money in just a couple years in real estate. The reality from what I've seen is real estate is a long-term game. When I look at different asset classes, the reason I like real estate is it's the surest way to get wealthy, but it might take a decade or decades. You know, if you're not thinking long-term in real estate, it might not be the right asset class for you. I like to think 5 years minimum. Now, that doesn't mean I'm not looking for passive income in the first 6 months and then quarterly thereafter or monthly thereafter. I'm definitely looking for that. But the long-term play of real estate, really adding incredible value to your net worth, is time. And it's purely due to inflation. As they continue to print more currency, the dollar back in 1971 was taken off of the gold standard and it changed from money to a currency. And that was the point in time where the Federal Reserve could simply create as much of it as they want. And as they create it, it actually is a silent wealth stealer. It's a silent wealth killer. And so I go back to my grandma, who is this hardworking, super frugal woman. You know, she ended up saving $93,000 throughout her entire life. And at the end of her life, she needed to be put into an assisted living facility and it was 10 grand a month. And within 9 or 10 months, it completely wiped her out. That's an example of what it looks like if you save dollars as your end game. Now, I'm not saying not to have some emergency funds, some reserve set aside, but the majority of my net worth is not sitting in dollars because it is literally being stolen from me every single month, every single year. If I had 100 grand back in 2020 and I let that money sit there and I spent it in 2025, it bought me 75 grand worth of goods. That is what I'm talking about, the silent wealth killer, the silent wealth stealer. You have got to get on the side of inflation. So as they continue to print, you can profit from it and maintain your living standards, maintain your financial status. Yeah, the advantage of getting into real estate early is the compounding returns, right? In the first 2 or 3 years, it may not seem like much is going on, but after you're 5, 7, or 10, if you can successfully drive net operating income, you can force appreciation while you're paying off your debt. That's the superpower of real estate. And for putting it really simple, you guys, if you can drive $1 of NOI, and NOI again is income minus expenses. That's your net operating income. And apartments are valued by net operating income divided by a cap rate. Long story short, at a 5 cap, if you can just go ahead and move NOI by $1, it's $20 of value on the exit. So on a larger property, we're buying a 229 unit property. Our business plan over 5 years is to drive NOI by $1 million. So if we can increase net operating income by $1 million and you exit at a 5 cap, it's $20 million of value. That's forced appreciation. That's how you're hedging inflation. That's how you're staying ahead of the money printing. And at the same time, while that's going off, you're potentially paying down your principal, which is your debt, and they're continuing to print currency, which when you go to exit and go to sell, now there's more dollars chasing that real estate, pushing the price up even further. As an operator, when we're managing 430 million of real estate and 195 million of equity under management, one of the most important and challenging decisions to make as the general partner, the operator, is when to send distributions. You know, as you go through a market cycle, there are headwinds that can come up. You know, a huge headwind that we've seen from any deals that were purchased back in 2021 was variable rate debt. Their interest rate was not fixed. And so deals that were purchased at that time were purchased at the peak of the market with this variable rate debt. The Fed obviously raised rates and it caused a ton of stress on a lot of these assets. And unless you could get that debt into fixed debt, you're likely in a position where you're selling right now because of being forced to sell. The lender said, hey, you've had your 5-year run, time to take the deal to market. And if you're being forced to sell, you're selling at the most inopportune time. If you were wise enough and smart enough to get that debt, variable rate debt, into fixed debt, now the question is do we send distributions? And a lot of times, you know, LPs, they want to see that passive income very residually. And it is wise to do that as long as there's enough cash in the business. And so a big decision being made at all times is, what is this asset going to need in the next 6, 12, 18, or 24 months of capital expenditures of cash to maintain the asset? And how much can we distribute back to investors? That's the one conversation that I think comes up most often is, hey, why aren't you distributing more? Or when will you distribute more? And that's 100% dependent on the performance of the asset and how much CapEx that asset's gonna need. Number 4, the power of networks. Yeah, real estate is not a fair business, I'll put it that way. It is about who you are. It's about your reputation. It's about your team members. It's about who you know, right? So we're buying a 229 unit deal in Plano, Texas, an A+ location, premier location. You got Whole Foods, Trader Joe's, Williams-Sonoma, Sephora, Starbucks, right across the street, all within walking distance with an A+ school district, one of the top nationally ranked school districts in the country. And the way those deals get awarded to groups like us is by being in the industry, by being a group that has closed many deals like this in the past, right? It's actually the biggest piece was we know the owner of this asset, of this apartment complex, we've spent time with at private events, right? Our lead acquisitions guy and Mike have spent time skiing and snowboarding, hanging out in the hot tub, just being buddies. So when you go to list a deal, and I'm just putting myself in the seller's shoes right now, the questions I'm asking are, who are you? How well do I know you? And what's your likelihood of closing this deal? And those are the pieces that are going to dictate if the deal ever gets awarded to a group or is even taken seriously. So step 1 for any real estate firm and any really wealthy person that I've met is you've got to have relationships with key people that you know, like, and trust. And as you build those relationships, the business becomes more and more unfair to your advantage. Not unfair into the sense of not allowing you into the real estate industry. We meet a lot of doctors and business owners at these different networking events. And the biggest mistake I see happen over and over again is they either move too fast and jump into deals, jump into relationships with people that they don't know, like, and trust well enough. They're just too excited. They get this kind of FOMO experience of like, I gotta get into a deal. I gotta make this happen right now. And a lot of times taxes can be pushing that. And I'll just tell you on the side note real quick, never invest in a deal for depreciation. first and foremost, make sure you're betting on a jockey that you know, like, and trust. And make sure you really like the fundamentals of the deal. You believe in the deal. So many folks got sucked into deals back in 2020, 2021, and early 2022 because as these deals turned over, they had these huge capital gains bills, and then they just dove into these deals for depreciation. Then the capital got completely tied up, locked up, and a lot of it even got lost. So step one is never invest for depreciation. But going back to the relationships, you've got to find people you know, like, and trust. And that relationship building can take time. Make sure you get some referrals from others who've invested with them. And just because a group hasn't done well on 100% of deals, that is not a deal killer for me. In fact, if I'm looking at investing with a group, I'm looking for a group that's done very, very well on many deals and had some challenging deals, and they're still here. The people that ended up getting taken advantage of, or most of the time investing with these newbies who've never been through a recession, they had a few deals that did pretty well because the wave was heading up and to the right. But when the market shifted, they got stuck in these deals and they got their allocated capital wiped out. So to really build a solid relationship, move slow, get their track record, see, hey, have you been through a recession? Have you been here for a decade? Have you been here for 15 years? And unless you have that experience, it's really, really tough to know how a group is gonna handle themselves when things go downhill. Because like Warren Buffett says, when the tide comes out, you can see who's swimming with their pants down. The way I found myself into some of these rooms was, first, I was reading a lot of books on finances. I was listening to a lot of podcasts, and I came across these commercials on these podcasts for these mastermind groups. And anybody really for a few $100, maybe $400, $500, $600 can go down for a weekend and you can meet operators in the room. And at the end of the day, if you can meet some folks in the room and you can build that relationship over a 3, 6, 9 month period, heck, maybe even faster if you really are motivated, you can now have access to some of these deals. I'd say one thing that is definitely apparent is it's difficult to get access to these private investment deals. So that's how I ended up getting in the room. And once you're in the room, I think it's important for you to have a certain level of education so you can start to decide if you like the co-GP and believe that they have the ability to actually move the needle for you financially, or if they're just not a good fit. And one way I also like to decide if we've got a great fit for an investor and us as a general partner is just similar core values. You'll get a good sense as you get to know these investors or you get to know these operators, if there's good synergy there, if you feel like it's a good fit. But at the end of the day, even with all that, you've got good core values, you've got some alignment, make dang sure the track record stacks up and they've got at least a 10 to 15 year period of being in the business and they're committed even when times get tough. Number 5, identity shedding. When I think about identity, it really controls everything about me and it controls everything about every human being, right? One thing that I always like to think about is the way you speak internally, it's how you see yourself. So one of the lines I like to say is I am an athlete, and when I say I am an athlete, it further deepens my belief and I start to behave and show up more like an athlete, right? I'll work out daily. I'll be monitoring what I eat much more closely. And so when I see myself that way, I tend to find ways to create that more efficiently. And so I think it's really important if you're looking to create wealth, you have to see yourself as a wealthy person. You have to be okay and like money. One thing I hear so much, you guys, right now is, this talk about between the haves and the have-nots. And the people that don't have the income or the wealth tend to not like the money. They don't like what's being talked about in the news and they have a lot of negativity around that. Well, that automatically repels any wealth from coming to you because you're not aligned. Your identity is that you don't like it. The identity is that I don't want to do more to create. And so, instead of pointing the finger, right? Point the 3 back at yourself. Whenever you got a finger point, Zig Ziglar says a finger pointed this way, you've got 3 back at yourself. The only thing we can control today is us. Right? I can't control what Trump does. I can't control what the blue team does. I don't really care if you're red or blue. Whether you're red or blue is actually irrelevant right now in my eyes. It comes down to what are you going to do? And the way you see yourself, your identity. If you just slow things down right now and truly ask yourself, do I like money? Do I want more of it? Doesn't mean you have to love money. Sure, I'm not for that. I'm for it as money as a tool. How can I create wealth so it allows me to create more freedom? So it allows me to have my parents come out here and be with us when I want to, right? So it allows me to be able to give back to a nonprofit. So it allows me to be able to buy the healthy foods, right? Those are things that I think money should be used for as a tool. And until your identity, the way you see yourself, is a person of wealth that appreciates, that likes money, it's going to be very, very difficult to attract it. And you won't take the necessary steps needed. It's very unlikely to rise above of how you see yourself or to move or behave in a different way than how you see yourself. It's almost impossible. So that's the inner game right there. Get your identity from a place where money is a beautiful thing and it helps you create a beautiful life. You don't have to love the money, right? They say in the Bible, I think it is, the love of money is the root of all evil. They say in the Bible, the love of money is the root of all evil. Sure, that's fine. What I'm saying is that money is a great tool and it can be used to make a beautiful world for you and your family. And that's the focus I have. And I'd strongly have you consider, if you don't feel that way, to look at your identity, because you can't act and be that person without that belief behind you. I think the first step people need to work on or take from going from 99 to a 1%er is their why. Why are they out to do something? Because until you have a clear why, you could do all of this different stuff. You could spend all this time, you could spend all this effort, and it's just not gonna stick until you really, really want it. I go back to that line. It's a powerful line and it's simple. When the why is big, the how is easy. And until you have a big why, until you have a desire, true desire, ideally a burning desire for a goal, it's just gonna be very unlikely to achieve it. So first, why am I after it? Then you can focus on the how. First why, now let's go figure out exactly what I'm gonna do. And once you have that why, the action is easy. You may never feel fully ready to change your identity. I can tell you, for me, it has been a challenge. And the belief about being able to become wealthy has been the biggest pivotal change for me. You know, when I was paying taxes as a snowboarder getting crushed, when I see my parents or my grandma getting crushed by inflation, I quickly learned I had to do something different. If you're an accredited investor and you finally want to shed some of that old identity, scan the QR code or click the link below to book a capital positioning call today. See you on the next one.